Did Jerome Powell just crash the market? And which market are we talking about? The real estate market, commercial, residential, the stock market, or maybe did he crash your local grocery store market? We don't know. We're going to find out today. We've got one of our financial experts on here, our lender, Dave D'Souza out of Glendale with Primary Residential Mortgage. And we're going to peel back the onion on here, and we're going to look at some of these. And our producer has clips from the FOMC meeting that Jerome Powell just had on the 18th here. And we're going to look at some of these different discussions and topics that were in that FOMC meeting. So I've got Dave D'Souza on. Dave, welcome aboard once again, my friend.
Thank you for having me, Cash. Good to be with you.
Always, man. I hope you're enjoying the holidays so far and ready for Christmas.
Working more than I'd like to, but yes, getting ready.
All right, good deal. So, Dave, what do you think, man? We have the Jerome Powell talking again, and this guy has got so much power. He says a couple words, and it could change markets all across the country, which will have an effect on the whole world. And on December 18th, here, his last FOMC meeting, he had a few things to say that my reports are a little confusing, not real crystal clear, and also a little negative in some ways. Would you agree with that?
I would. And if I may, I just give you a little bit of perspective, and a couple of other things last week affected. Okay, so let me give you a little bit of scoop here. Interest rates ended the week about 1/8 of a percent, 0.125, actually better than the week before, which was a little bit of an overall surprise. Stock market, however, ended the week about 2% lower than it did the week before. So the stock market ended the week down. Interest rates actually improved slightly this week by about 0.125 net for the week. There's a couple of things that affected both the stock and the bond market, or the stock market and interest rates last week. And I'll give you a quick recap on them. There was retail sales, which actually came out a little bit stronger than expected. So that wasn't particularly good for interest rates. There was also the PCE, which is the Federal Reserve's favorite gauge on inflation, stands for personal consumption expenditures, which means what people or households are spending on groceries, utilities, housing, et cetera, et cetera. That also came in a little higher than expected. So that was not particularly helpful for rates. The big ticket item for the week was the Fed's announcement on Wednesday of dropping interest rates 0.25%. But that 0.25% they dropped interest rates was already baked into the markets, as we've said in previous discussions. However, there was a 30 to 40 minute press conference that followed, and it is clear by the results that the answers to the questions in that press conference were not things that made the markets comfortable. I will hand it back to Cash to give you a little bit more perspective, a little bit more detail. But both the stock and the bond markets reacted very negatively to the Federal Reserve's press conference on Wednesday. Cash, take it away.
Fantastic. Thank you for that, Dave. So having said that and hearing that now from Dave, what are the markets going to do? How are they going to react? And should you be concerned? That's what we're going to talk about further in this discussion about what is going on. Again, we're going to talk about some of the fear factors that people use out there on social media, the different internet channels, and newscasters as well. They've been using them for years. The hook, if you will, to get you into the story, scare the heck out of you, to get you to pay attention and listen to whatever it is they're selling, right? Typically at the end of the day. So our producer, Amy, who is on here, and she's done an amazing job on putting together a lot of these videos that we have all the time to bring you some great information. And she's also behind the scenes, always bringing us some analytics and info that we didn't even know about sometimes. So we've got Amy on here. Amy, how you doing?
I'm doing well.
Oh, we love having you on. So this is fantastic. This is great. And Amy has found some clips from the FOMC meeting with Jerome Powell. By the way, FOMC, we always keep hearing that. And yes, that's when the Fed talks, basically, at the end of the day. What does FOMC really mean? Dave, what does it mean, pal?
FOMC stands for the Federal Open Market Committee. And it's comprised of, I believe, 7 people, one of which is Jerome Powell, and he's the chair. And then there's 6 other members.
Exactly, right. So it's 7 people, and that's including Jerome Powell, right?
Correct.
Okay, gotcha. So whenever we hear the FOMC, that's when the Fed is going to talk, and he's going to share all the information that him and his committee have put together, talking about the markets, interest rates, the economy, and everything from the 10-year Treasury and the PCE and all these different numbers that will have an effect on our economics across the country, which, again...
And interest rates.
And interest rates, yeah, absolutely, 100%. So Dave, Amy, I mean, you guys want to bring up clips and look into that right now?
Yes, let's start with the one from Neil Irwin from Axios.
Neil Irwin from Axios. All right, let's look into this. You got it loaded up?
This.
Neil.
Got it.
Thanks, Chair. Maybe Chair Powell, Neil Irwin from Axios. Financial markets have been very buoyant really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions. Of course, that's part of what we do. But, we really look carefully at is the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of just take the last year, we've seen inflation, over the last couple of years come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restrictive. We can also look more directly at the parts of the economy that are affected by that are interest sensitive, like particularly housing. Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. A lot of things move financial conditions around, as you know, and we don't really control those. But I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefits in the U.S. government building a reserve of Bitcoin?
He goes on to Bitcoin now, but do you guys want to comment on what he said about housing?
Yeah, that was interesting that housing is at some very low numbers. And yes, it has been some of the lowest we've had since 1995. That's a long time that we've had some of the lowest sales reported since 1995. And that's a result of really the affordability factor from high interest rates.
Well, and one of the things that I'd like to just clarify, he says that the Federal Reserve's restrictive policy seems to be working. But he said that right after saying the housing market has been quite severely affected adversely. So I don't think he means to say that the restrictiveness of high rates and the subsequent softening of the housing market is working, so to speak. But what was interesting is he didn't really comment on what could be done to help the housing market. He just clearly stated, yes, the housing market is essentially in a much softer place and more of a slump than it's been. And I think what would be interesting to see is if maybe one of the other reporters could ask him, hey, what are your thoughts on what you can do to help the housing?
Dave, that's a great point, man. 100%. You're exactly right. I was going to say.
I'm going to interrupt.
Oh.
So here were his two lines that I want you guys to go on about. Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working. It's transmitting, and it's having the effects on our goal variables that we would want.
Okay.
What do you think?
Which is kind of contradictory because I don't think they want to slow down the housing market.
No,
I don't know, Dave. I'm starting to wonder.
Down and it's working, and that's our policy.
I'm starting to wonder. What is the deal with this guy? I mean, it seems like housing just doesn't matter to him a whole lot.
I think he wasn't really thinking because he's answering off the cuff. I think and again, I don't know, but I would offer that I think he's trying to say, okay, our restrictive policy is helping bring inflation down. I think it would be fairly counterintuitive for him to be suggesting that slowing down the housing market is working. I think he wasn't really thinking about what he said and how it relates specifically to the housing market, because while they might want to slow down inflation, I can't imagine under any stretch of imagination where they'd want to slow down the housing market. But again, we don't know what he meant by that.
So you're feeling like maybe he misrepresented that, just wasn't quite prepared for that answer off the cuff.
Yeah, he wasn't. He included a lot of things in that were affected by the restrictive nature of the policy.
Mm-hmm.
I don't think he really thought that far ahead to say, wait a minute, I just said that restrictive policy is working, i.e. slowing down the housing market. I don't think that's what he would have intended to say. But again, maybe he just wasn't thinking clearly.
Dave, perhaps, maybe. I don't know. That seems like kind of a far stretch for me to bite onto that one. I don't even know if I want to nibble on that one. But okay, maybe he did. But he just seems like a pretty smart guy, pretty darn analytical by nature. And you would think that he had plenty of time to think about that answer. Talking about the housing
So you're
market.
thinking maybe he kind of was hinting at the fact that maybe it's not such a bad idea that the housing market has slowed down?
Yeah, I think I have a feeling that he does want it to be slow. Doesn't want it. And I don't know why, because my problem with that is every time a house is sold, and this not just because I'm a realtor and I help people buy and sell homes, because one way or the other, people are always buying and selling homes. It's just that right now, people are buying and selling homes only if they really need to. There's not that, I just want to get into a new neighborhood, or I just want to get into a different house floor plan, or I want to get away from the crazy neighbor living next door to me. Those reasons aren't enough to really push people to get away from that, 2.99 interest rate that they've locked down, and make the move and get into a, where we at now, 6.25, 6.5, right? 6.5, right, Dave?
Mm-hmm.
Yeah.
6.375 as of Friday. And I'll just touch on an interesting statistic that you mentioned earlier, and forgive me if I'm wrong. You said 70% of mortgages out there are at 4% or below.
I did. Yeah. Well, I didn't say that, actually.
You quoted somebody else as having
Grant Cardone. I was quoting Grant Cardone, and that's something I want to talk about here in just a minute. But yeah, what's your question about that?
No, it's an interesting statistic, because if you think about it, if the implications are that 70% of people who have mortgages are at 4% or below, and the current market even aggressively is at 6.375, that in itself is highly restrictive.
Yeah, exactly, 100%. So
home prices are different too.
What's that?
The home prices are very different unless you're moving out of state, making a move from a state where it's higher price to lower price. But not everybody does that. Some people just want to move within the same state or same region. So then the home prices are not going to be anything close to when they purchase that house.
I think from my perspective, just looking at what happened, there was a time during COVID when home prices started to go up. And while interest rates were lower, even though prices went up, but interest rates were low, was not particularly restrictive. So I would offer from that higher interest rates are more restrictive, or have a more restrictive effect than higher prices.
Oh, I think definitely, especially on some of those states that were making a big boom. Some of those states have, I don't even know the numbers, but it's astronomical, the amount of people that were moving to some, like Florida, Texas. So
yeah, absolutely right. But now we're coupled with both. We have higher prices and higher interest rates. So the affordability factor has just shot down for a lot of people.
Mm-hmm.
I mean, let me put it this way:
they're paying cash. Sorry.
From a broader perspective, at the worst, I would say we had 30-year fixed rates close to 8%. And if we're at the 6.375 range now, we've seen about a 1.5% improvement in rates. But compared to the recent lows in the mid fives, the market has ticked up since then. And I think that may be discouraging for some folks, even though it shouldn't be. And even though, as you pointed out earlier, the headlines may read, okay, Powell crashed the markets. But the reality is 30-year fixed rates actually improved a net of 1/8 for the week.
Right.
So maybe that's a segue for, a comment that you'd made earlier, is sometimes people tend to overreact to the headline.
Well, and that's the point of our discussion today, is we don't want people panicking. You've got to read the whole story. And I'm going to
dig a little deeper.
Sorry?
Dig a little deeper.
Dig a little deeper. Don't be an eye-level shopper. Let's look into the story and see what's happening, because I'm going to talk about Grant Cardone, what he's pressing right now on some of his ads. And it's a scary ad that he's got running out there. He's coming on saying the real estate market is going to have the most catastrophic crash that we've ever had. It's going to be way worse than 2008. It's going to be horrible. It's going to be terrible. And it's coming soon. So get ready, prepare yourself. And that's his discussion on some of his ads. So my God, does this catch your attention? Does this scare the heck out of you? If you own a home or you own anything,
and if you don't read any deeper, your immediate interpretation is, oh God, he's talking about my house.
Do you know how many people will just see that tiny little 10, 15 second, and then they go on with something else. And then the rest of the day, that is in their mind. It's in the back of their mind.
And they're telling everybody that they meet, the real estate market is going to crash.
The real estate market is going to have a catastrophic crash. Grant Cardone said. And Grant Cardone, he's a smart cookie. This guy's done very well in the real estate space. Big time.
He's a successful investor, yes.
When he talks, a lot of people listen, right? So as you dig into the story, right, he starts to unveil the real truth of that hook. He hooked people in with the fear, right? Yes, real estate market can be crashing catastrophically, but he's talking about commercial He'll even go on to say, not residential, commercial only he's talking about, right? So now he's got everybody's attention. So half the people bounce off because they have houses. They're worried about the residential market, right? But he's not worried about the residential market at all. At all is he worried about it, because about 70% of homes out there with mortgages have a mortgage less than 4%. Less than 70% of mortgages have a 4% interest rate or under. And then the rest of them are pretty much owned all cash. There's no mortgage at all. My numbers that I've had in some of our previous videos we've done is about 39% of homes out there in the United States have zero mortgage. It's all owned, all cash. That's it. So it's amazing. One of the highest numbers we've ever had of complete ownership in our United States of America.
Well, and just to add a little piece on that point that you just made, again, we mentioned earlier in the podcast, if 70% of people, and that's 70% of potential sellers, have a 4% or better interest rate, and any new home they're going to buy is going to be 6.375 and up, that in itself refers back to the quote unquote restrictive nature of interest rates that Powell referenced in his conference.
Right. 100%. Yep. And words are powerful. Just like you said, maybe he didn't mean to say it that way about the housing market, or maybe he didn't mean to present things a certain way. You know, maybe having an off day. Who knows? Maybe he didn't get a good night's sleep last night, or the coffee wasn't good this morning. But regardless, the things you say and people are listening to every word you're saying can have a profound effect on the results of how those people are going to take that information and put it into their mindset, right?
Well, and there are certain people, like the president, or in this case, the chair of the Federal Reserve. There are few people that are not listening when this man speaks.
When Jerome Powell speaks?
Yes.
Yeah.
So to your point, I'm sure he has to be extremely careful about what it is he says.
Yeah.
Because his words have the power to move hundreds of billions of dollars.
Hundreds of billions of dollars. Yep.
Didn't all the markets react awful after the press conference?
Yes.
One of his answers here is, I think it's pretty clear we've avoided a recession. I think the growth this year has been solid. It really has. That was one of his answers.
Isn't that always the Fed chairman's goal, is to avoid recession? Like, if we had a recession on his watch, that'd be a failure for him, right?
Well, and you know this whole notion, if you've heard the word soft landing. So when you have inflation that's high and you're raising interest rates to bring inflation down, a soft landing means you bring inflation down, you keep interest rates restrictive and bring inflation down like landing a plane, but don't make it so restrictive that it becomes a crash landing. So a soft landing means you use interest rates to lower inflation, but just bring it down just gently enough so that it ends up being a soft landing. And what he's proposing is that we have reached a soft landing, versus if it was too restrictive and then drove us into a recession, that wouldn't be a soft landing, that'd be a crash landing.
Right. Gotcha. Okay.
I don't know if that helps.
No, it does. Pretty interesting stuff, you know, in between the fear factors, the hooks that people use. Maybe a guy like Jerome Powell, maybe he's saying things to move things a certain way that he wants it to, or to not, or maybe it's an accident, or just misrepresentation.
Let's say something cost $5, and because of inflation, it went up to $6. And people were they were okay with it at $5, but they're really struggling with it at $6. Leaving it at $6 is not going to fix the problem, because at $6, even if inflation was 2% and it went from $6 to $6.02, it's still high. So even though inflation hasn't gone up, the prices have not come down. What is going to, even if inflation hits the 2% mark, all inflation hitting a 2% mark means they're not going up that much anymore.
Right.
But if something is already too high for people to afford and it's not going up, it's still too high. What's going to fix the problem? The price has to come down.
Yeah.
So even if inflation was at 0% right now, people would still be struggling. Why?
Right.
Because something that used to cost $5 still costs $6.
Right. You know what's funny about that? My measure is when I go feed myself lunch. When I'm out working, I'm running around, I'm driving about, I got to get something to eat. I remember back, I pull over and eat something for $5 or $6. You know, something quick and decent. Always trying to find something healthy, right? But that's hard for $5 or $6. And then all of a sudden, it was like about $8 or $10. Then it's $8 or $10 to feed myself a lunch. Now today, it's 15. I'd say 15 to $18 to feed myself. And this is this is not going to a restaurant. This is self-serve food. This is like going to Whole Foods, which I know Whole Foods costs a little bit more, but there are ways to shop there smart. And I found those ways, right? Or you might even go to Sprouts and I'll go hit the deli, right? Get a nice sandwich over there. That's actually very, very reasonable over there. $9-10. I'm in and out with a really nice fresh deli sandwich. And there you go. But my measure has been what it's costing me to eat lunch when I'm out and about.
Even using that example that you just did, let's say it used to be $5 and now it went to 10 at some point. And now it's, let's say, arguably 14. Even if inflation stayed at 0%,
yeah,
the price is still $14.
The price is the price. Yeah.
So all you're saying is, okay, thank God it didn't go up from 14, but I already couldn't afford it at 14.
I think the answer to that, Dave.
So let me just finish my thought real quick. And that's why what I'm saying is, beyond just inflation not going up, the reason people are struggling with prices is why? Because they have not come down.
Correct.
Sorry, go ahead.
So what is going to make them come down, right? It doesn't have to be a crash. It has to be more supply. That's what we have to have.
And that's where the Federal Reserve's answer is, well, the way we bring prices down is we raise interest rates so people can't afford to buy, and then the sellers will see nobody's buying, and then they'll bring their prices down. But truthfully, there are certain things that people have to buy.
I don't think that's working so well because people still have to buy.
Yep. Groceries, bread, eggs, milk. You got to buy that. If milk went up to $20, people would still have to buy milk.
So what they're doing, though, and because their income levels aren't staying up with the inflationary rate,
Correct.
Right?
Correct.
They're putting things on credit cards, and credit cards are at the all-time high.
From what credit debt is exceptional right now. Yep.
Exceptionally high. When you say exceptionally high, right?
Yes.
The levels.
And exceptionally high combined with high rates. So not only are people borrowing more, they're also borrowing at higher interest rates.
24%. I mean, it's like these guys are like, mobsters, with the credit card companies, oh yeah, everyone's starting to get more debt. We're going to stick it to you. Maybe that's an incentive to pay that debt down real quick. You don't want to leave that lingering around too long.
I don't know how this would happen and how this could come into play. And it sounds really, altruistically, beautifully, to present. But what is going to solve the problem of people, even if inflation comes down to 1%? By definition, okay, that means the price is either stable or going up slightly. It's not coming down. What is going to have people feel like they can be more comfortable with prices? Prices have to not just not go up. They have to come down. And I'm not sure how that is going to happen, but prices have to come down and then people will find it more affordable.
I do. It's going to be less taxes. There's got to be less taxes for these companies, number one. And there's got to be more supply, maybe less regulation, less taxes, which will help increase more supply. And then our supply and demand ratios start to come into effect.
So you're saying if the companies had to pay less in tax, they could sell their product for a lower price.
I have clients of mine that own restaurants, for example, and they've shared with me. I say, how's business? Business is through the roof. It's lines out the door. But the problem is they're not making any money because they're paying the high wages to the employees. They're paying all of the other fees and everything else included, and the taxes and everything is through the roof. Yeah, the lines are through the roof, but so is that. And the cost of buying the foods. This client of mine has shown me that, yes, you could buy cheaper foods. You don't have to get all organic or all grass-fed, but then there's level A, B, and C. And my client would always buy the level A. It's more expensive. But then you go into the organic and the grass-feds after that, right? And then you're going to get really expensive. But here you got 3 levels that are like, the cheapo stuff, you probably find in like McDonald's and, all these kind of places and Kentucky Fried Chicken. And then you got the couple steps up from that. This guy would buy all the good top of the line product. But he's saying now it's getting so expensive, it's just pushing people out the door.
You're just, if I'm understanding what you're saying that the reason this particular restaurateur cannot afford to lower his prices because then he's going to go out of business. It's going to cost him more to produce the meal
Correct.
than he can actually charge. So the question is going to become, where do we start to lower prices, to be able to make it feasible to not just keep prices from going up, but to actually bring them down? And that's a very difficult question. I'm not sure how. I know that COVID caused prices to go up. I do believe that there are many vendors that could afford to lower their prices and they're just not. Not your restaurateur as an example, but there are other vendors that could lower their prices that just aren't.
Well, I think things like workman's comp, things like a minimum wage restrictions that keep increasing. I'm not. Is it $20 an hour now in California?
I think,
People getting paid?
I think minimum wage in California is 16, but it's going up to 20. And no, actually, it's 16 for most industries, and I think for the fast food industry or
Yeah.
like McDonald's, Burger King,
Right.
Coffee Bean, that is now $20 an hour.
And let me ask you something. When you go into these places, does it seem like service has gotten better? I know they're getting paid more, but does it seem like the service has gotten better overall?
I wouldn't say better. Definitely not proportionately better service than the service we were getting at $15 or $16 an hour. Not my personal experience.
Yeah, because
I mean, I'm not saying it was bad before and it's good now, or good before and it's bad now. I'm just saying I haven't noticed a difference since the wage increase went in. But I know that it is more expensive for employers to keep staff now.
It's more expensive to keep staff, and they've got all kinds of different rights and all these regulations that follow them all around the place. And then it becomes this whole like standoff kind of a thing. Like, God, it's got to be scary to own a business where you have to hire lots of employees, like in a restaurant.
Well, I think about this too. The price that you pay, the hourly wages that you pay your employees is all factored in with what it costs to produce a meal and deliver a meal to the client. Because there's the cost of the ingredients to prepare the food. There's the cost of the delivery to get the food shipped to you. There's the cost of the staff to cook the food. Then there's the cost of the staff to present the food to your clients.
And then somebody's got to clean it all up, Dave, and put it away, right?
Well, and that's my point is the overall cost to produce has gone up. And I'm not sure how, but somehow we have to figure out a way. If we want to get people where they're not uncomfortable with prices, as an economy large scale, we have to figure out some way, not just to prevent prices from going up, but to help them come down. And that's the tricky part. I don't know how we do that, but therein lies the problem.
I think that's going to be getting back to some of the basics. A natural competitive market. That's what we have to have, and you can't force people. They have to hire all these people, and they have to hire so many people, and they have to pay them this wage at a minimum. And then they don't even have to be good at the service, because then if you fire them, then you got all kinds of problems from that too. So now you're tempted to really just keep not tempted is not the word. The motivation for you is to keep people in staff, not fire them, because that's going to probably cost you a lot more money at the end of the day. So there goes more money out of your top line, right? So I think we've got to free things up with more of a natural competitive market for people. We've got to make things more readily available by improving taxes, more tax breaks for some of these companies so they can push forward some of the savings to the
right. In other words, lower their cost to produce.
Lower their cost to produce, right? Which was also going to increase more. There's going to be more production. There's going to be more foods and different things available to bring down costs.
And just to take a quick look back for all of you, and Cash, please tell me if you want to add anything to this. We had a certain level of balance between supply and demand, and then COVID came along.
Right.
And with COVID and the limited supply chains and the scarcity of goods, that created an environment where the cost to produce anything skyrocketed. And now that COVID is sort of passed on, I mean, yes, COVID is still there, but it doesn't represent anywhere near the threat that it did before as far as, to the economies of scale. At the end of, and I'm by no means suggesting that COVID is gone, but what I'm saying is its effect on the markets has diminished severely. Unfortunately, all these costs to produce that went up, it never came back down.
That's right.
And so we've had a situation where prices went up and stayed up, but wages didn't go up by the same amount. So Unfortunately, COVID happened and supply chains got affected. We can't change that. What we have to figure out in an economy is now, okay, can we afford to scale back? And that, my view on this is the onus of this falls largely on the people producing, whether it's whatever their different pieces are that contribute to their cost to produce. They all need to get together and say, okay, instead of being greedy and holding on to those price points from COVID, what can we do to lower the cost to produce? So instead of not just fighting prices from going up, but what can we do to actually lower prices for the consumer? And then you'll see the consumer say, okay, inflation is in line, and now we're no longer finding prices too high.
Right.
But of course, this is something that's
there's some good truth to that, Dave. That's a good point. Real well made.
Yeah. Well, Cash, I'm going to offer something, and then I'll maybe you can expound on it a little bit. This is up for discussion, and you can comment what he meant when he said things that we don't have control over. And what little I've read about it and what feedback I've gotten from the capital market side is that he's referring to prices. In other words, he may and the open market committee might open and close the faucet on interest rates to try to adjust the flow of money so people can and can't spend. But what he doesn't have control over, or what the Federal Open Market Committee does not have control over, is the prices that vendors are selling their products for. As we were saying just now, the price that it costs to produce. The Federal Reserve has no part at all in what it costs someone to produce. And I have a feeling that might have been what he's referring to when he says there are parts of this that contribute to high prices that we don't have any control over. But Cash, maybe you or Amy can comment on that.
Well, again, back to what I said earlier, it's the same thing, that if you help control and then also increase production for some of these products that are going to, make more a fair market out there as far as competition. Competition is always going to set the price for every company out there, every retail company out there. They're competing against other ones. They're going to have to compete with the price. But then again, when we talk about labor and workman's comp claims and the cost of the goods to provide for people, that has all just gone through the roof. Those need to come down. And taxes.
Correct.
Giving people better tax cuts on these things and less regulation. Everything is so regulated and so taxed that it's insane, and it's got to stop.
Right. And I think to summarize what you're, if I'm understanding you correctly, the reason prices are high and they have not come down is because the cost to produce is still high. And I fully agree with everything you're saying. I completely 100% agree that
Dave,
in order to lower that.
Amy, that's a first. Did you hear that? Dave completely agrees.
I completely agree with you. Prices do have to come down. And the only thing that I'm offering is, and maybe you can comment on that, what part of that do you think the Federal Reserve can help with? Or is that something that you feel?
I don't know if the Federal Reserve can help. That's the government. We've got other bodies that are going to have to be involved with that.
And I think that's what he might have been indicating when he said there are parts of this equation that we don't control. And I'm only offering that I think that may be what he was referring to, because there are many parts to the puzzle. But to your point, not to oversimplify this, but the reason prices are high is because COVID made it very expensive to produce products for the consumer to purchase.
Right.
And once COVID sort of took on a new phase, the cost to produce, for whatever reasons, has not come down.
Right. I mean, what he has control of is interest rates, overall credit cards, bank loans, investments, all these type of things, cars, houses, mortgages. Businesses need to borrow money all the time.
Which some people could argue does have something to do with the cost to produce, because if the interest rate that businesses are using to borrow to produce is lower, maybe that could filter into lower prices.
Right. I agree 100%. Again, Dave, we're on the same page, my friend.
It's not a simple solution. It's definitely a very complex solution. And we just have to hope that however it happens, I personally feel like the answer is not just to bring inflation even to 0%.
Right.
The answer is to take that sandwich that used to cost $5 that went to $10 and then went to $14.
Yep.
The plan is to get that price of that sandwich back to $10 or $11.
Right.
And then you're going to see people feel more comfortable with prices.
Right.
Which is still higher than the $5 it was, but not as high as the 14 that it maxed out at.
Right.
Where did his 2% number come from?
Where does that come from?
This like single track mind on, but 2%.
I can offer you on that one, Amy, it's not that he specifically thought through and came up with a number. That is a historical number that the Federal Reserve has always wanted to target. So it's just been a historical trend that economies have analyzed that if you keep inflation at a 2% annual increase, that should keep it in step with people's increase in wages. But I think this 2% number is just a number that's been around for a long time. And nobody's ever really revisited it to say, okay, wait a minute, what are wages doing right now? And to Cash's point, we talked about this. There was some talk that he is revisiting this, and the Open Market Committee is revisiting this 2% goal, and now they're maybe thinking of revising it to 2.5%.
That's what I hear. Yeah.
Is that okay?
So a quick little search, I came up with this answer. The concept of inflation targeting as a monetary policy framework is often attributed to the work of economists at the Reserve Bank of New Zealand in the early 1990s. However, the specific target of 2% inflation is often associated with the Bank of Canada, which adopted this target in 1991.
That's interesting. So we're using something that's about 24 years old.
A little archaic.
No, 34 years old from Canada. Interesting. Well, to your point, Amy, this is definitely something that should be revisited. I would offer.
How about that, eh?
I would offer that the annual inflation should be fairly much in step with wages. And that's how, because if you increase prices and wages don't go up, you got a problem.
Right.
If you increase wages and prices don't go up, then you're going to have the reverse. The two have to sort of be in step to keep it stable. Sorry, Cash.
Dave, let's look at that, which we do have a problem. We have a problem right now. And he's been saying the inflation has been batting around for how long now? 2.5, 2.2, 2.7, under 3%. For how long now? How long have we had that inflationary rate?
I would say at least the last 6 months on and off.
Last 6 months. But it seems like, I don't know, it doesn't seem like that's true. Seems like it's going up higher. Like costs of goods, products and services are not going up 2%. Every time I go into a store, it's like it's 5% more than it was last week. Sometimes
it's a summary of a broad scale of things that they use to come up with the number. I don't know how accurate the numbers are. There's three indices. There's the CPI, which is the Consumer Price Index. There is the which is what the prices that people are paying. There's the PPI, which is the Producer's Price Index, which goes back to what we were talking about, the price to produce.
Yeah.
And then there's the PCE, which is the Fed's favorite gauge, personal consumption expenditures, which means households like yours and mine. What are they spending on housing, on utilities, on groceries, on bread, on gas? So I don't know how accurate the numbers are that they're putting out.
Yeah. If
the increase in these numbers is not co-measured with the increase in wages, we're going to have a problem. And what we obviously, there's no wage environment that we've ever seen, at least not recently, where wages have gone up 9%. So when you saw inflation at 9% and wages are only going up, I don't know, maybe even a lot of people are out of work. Right. There was a huge gap between the increase in prices and the increase in wages. And I think that gap has come down now. But to your point, it's been really sticky now. We haven't gotten to the 2% mark. We're in that 2.5, give or take.
Right. If I could share this with you, Dave, yes, the CPE and all these numbers and measures on the economy are, yes, I get that, the analytics of the whole thing. But what I think is even more important than that and more telling is the CCL, okay? Cash's cost for lunch, all right? That is the one that really tells us what's going on out there. I can see what's happening as I'm living in today's world and economy and spending money on goods, products, and services. I see what's happening. So you can give me all these numbers you want all day long. But come on, let's be real.
No, I have one just like that. It's called the DCC, Dave's Cost of Coffee. Exactly. A year and a half ago, what cost $4.75 today, this morning, cost $5.95. That is a 25-ish% increase in a year and a half.
That's why I drink green tea.
Ridiculous, what is?
You got to drink green tea when you go to Starbucks. It's $1.50.
You got to start drinking water.
That's costing a lot too these days.
A lot more too.
Yeah, pretty soon you can't even afford to drink water in this country, unless you want to drink the tap water. That's free, I guess, but that's
New York.
Liquid death. Yeah, New York tap water is good. That's why they have some amazing pizza there. As you ask all these pizzerias around the different boroughs, what is it that makes your pizza so good?
It's the water.
It's the water. It's the water.
Yeah. God, I miss my New York pizza.
Amy took me to a borough in Queens. I'm pretty sure it was Queens, and that was the best slice of pizza I ever had. That's so memorable. I remember it folded in half, a little greasy. The cheese was awesome. The flavor was just amazing.
Oh,
And that was what was that place you took me to?
Philly's Pizza in Queens.
Phillies
Oh,
and Queens. Yeah, yeah.
oh,
It was really. That was
Okay,
an
you guys are
experience.
making me hungry. You're making me hungry, and you're making my doctor nervous.
Yeah, right. Good laugh. So,
Philly's
hey,
Pizza.
I don't know. Can we talk about what's coming up for 2025 and everybody's speculations and thoughts on that?
Well, I could tell you from my perspective, my outlook for interest rates. I'm going to maintain what we said in the last piece was, if we see rates come down to the 6% mark, I'll be happy. I'm not expecting at this point to see them go much below 6%. If we could even get to 6% and stay there, I'll be happy.
If they can get to 6% and stay there, you'll be happy.
5.99. And
Okay,
I'm
I'll see your
6.375 as
5.99.
of Friday.
Okay.
So we have
fine.
about a 3/8 to maybe a half point improvement that I'd like to see.
Yeah.
If we get more than that, that's gravy. I would like to see us at least be able to come down to there. And I've sort of reestablished that with some of the recent changes and things that have happened. And especially, part of it being the Fed's recent approach of what they're going to do and not do with interest rates next year. My pass on to our clients would be, do not sit around waiting for 4%, 4.5%, even 5%.
Yeah.
Marry the house, date the rate. If the price is right and you're in the 6-ish rate, you might have to bite the bullet till rates come down a little bit. But if you're thinking about waiting till rates get into the 4s, maybe even the mid to low 5s, you might be waiting a lot longer than you think. But Cash, please chime in.
No, I agree with that. And based on what the Fed was saying with only 2 cuts for 2025, again, that could change at any time. I've seen it change. I've seen them switch back and forth all through 2024.
Correct.
I don't know how many times. But all that being said, let's say the rates do stick around 6% or 5.99. I have a feeling they might get down to 5.75, 5.75. I think that's probably going to be about as low as we get. This is what you got to do. It's just like 2024, intelligent purchasing. And what I mean by that is really have a good lender. You've got to have a good lender. If you're buying with a mortgage, you're paying cash, it's a non-issue, right? Just call cash and we will save you cash.
I thought all your transactions were all cash. All cash McCallum.
All my transactions are all cash.
All cash
But
McCallum.
we will definitely negotiate and save you money anyways on the transaction. But if you are doing a mortgage, which there's a lot of people doing a mortgage and borrowing money to buy these homes, then you have to really employ some intelligence in the lending, just like in 2024. And what I mean by that is with buy down rates, whether they're short term or long term, whatever you're going to do, you've just got to look at it. Floating rates, even, you're watching the news and you got to pay attention and keep good communication with your lender and your agent, so you can follow these things all along to the finish line and save some money and get you the best rate.
I was just, to your point, the working relationship between a lender or between your realtor and your lender is absolutely critical. Case in point, and Cash and I have had this happen before. Just yesterday, one of my clients and the realtor, we were one of 13 offers on a property in Pasadena. And out of 13 offers, we were not necessarily the highest offer. We were one out of the 13, competing with a couple of offers that were cash offers. I had a conversation, as Cash and I do on every transaction that we do together. I had a conversation with the listing agent, describing my ability to perform, describing the buyer's pre-qualification, pre-approval. And The listing agent then called my agent, the buyer's agent, and said, we're going to go with you guys because we feel confident that the lender can close.
Yeah.
My point to that is, in the way that Cash and I have always worked together as a team to secure the relationship with the client, the working relationship between the lender and the realtor is critical, absolutely critical.
Yeah,
Cash,
it really is.
You can comment on that if you like.
You've got to have fantastic communication. You've got to ask questions and you've got to pry things open a little bit. I've even had deals where other agents have brought buyers on some of my listings, and the lender sometimes knows more than the real estate agent. And sometimes it's vice versa. Maybe the real estate agent has a lot more knowledge than the lender, but at the end of the day, they're not communicating. There's something missing. They're missing a spark there. And when they can put these deals together, and it's sad because it'll cost buyers and sellers money and aggravation. So hopefully everybody is crossing the T's, dotting the I's. They have the intelligence. They know about all plans possible, all different directions to make things happen. Buy downs. Yes, the interest rate's high, but there's ways to get around that. There's all kinds of different ways. Coming back with credits and money back or reducing prices. There's always a way to make something happen. You just got to kind of chip away at it a little bit. But again, communication is the key. Always.
Couldn't agree with you more, sir.
Yeah, great. Well, hey, Dave, I'm telling you, this is a phenomenal day. You and I agreed on a lot today. I mean, this is a milestone right here.
Yes,
unbelievable, man.
Next week, let's get back to talking about some AI and doing a recap of the year and seeing where 2025 is going to go. I think we know that the Fed is always a wild card.
Yeah,
right?
I'll go with wild
Take
card
it
on
away,
that.
Cash.
Yeah. So, in talking about 2025, we're going to definitely keep you updated on everything and with AI and what's happening in the markets, talking about our wild card, the Fed, Jerome Powell, what's going on, because he's still going to be in his position all through 2025 and into, I think about mid-year 2026 it is, but May, I believe. So we will have Jerome Powell around for a while still. And but we will, Dave and I, keep you up to date on what's going on with interest rates and the markets and the speculations, so you can make the best moves going forward all the time.
And especially in a market where it's volatile, meaning it's moving a lot, information on a weekly basis, like we share with you on these podcasts, is vital.
That's right.
That's the only way you could wait 2 to 3 weeks or a month, and it's a completely different environment.
That's right.
We're just offering you that. If you keep up with us on these weekly podcasts, not only will you stay informed, but it's also a great opportunity for you to reach back out to Cash with some feedback. Send Cash the questions you have, things that you would like to see discussed, questions you'd like to have answered, and we will certainly address those for you.
Because you have found the real estate information superhighway right here on the Cash McCallum Show.
Absolutely. Well, on behalf of all of us, wishing you all a very blessed and safe, happy holiday season.
Absolutely. Merry Christmas and Happy Hanukkah.
And Happy Hanukkah.
Happy Hanukkah and Merry Christmas to everybody.